And welcome to the TSP Weekly Podcast. Every week, you get to see two old guys talk about TSP. Or maybe we're not that old. I don't know. I'm feeling old.
Sometimes I feel old. Sometimes I feel pretty good.
Yeah, I'm with you there. The snow's not helping.
No, snow's not helping at all. I think we're like the last day or maybe tomorrow, the longest sub-freezing stretch in like 25 years or something.
Yeah, you get to escape it next week, but it's supposed to be around for a while.
Yeah. My son's up in Boston, and he sent me a picture, and it reminded me of the blizzard of '78 when I was a kid.
Yeah, I have no use for this stuff. I'm glad we only really do it once a year, but hanging around this long is crazy. And you know you're getting old when all you want to do is talk about the weather anyway.
Right. There's a lot to talk about this week, man. We talk about volatility all the time, and it's with respect to TSP, and you're not really seeing it. Certainly not seeing it in the C funds. The C fund's been more or less sideways for the last couple of months, but precious metals, gold and silver, platinum, palladium. I mean, they have all been copper now too. They've all been skyrocketing, and this week, I mean, they tanked. Like if you had just figured it out and got in, gold's down like 8% as I'm looking at it. Silver's down 20% today, just today. There's a Sprout platinum palladium ETF that I follow. It's down like 25%. That's so what I'm basically saying is volatility can come and go in different segments of the market, and just because we're not seeing it in TSP doesn't mean there aren't a lot of things happening below the surface, because there are a lot of things happening below the surface.
Yeah, there always is. And back to the gold and silver thing, I can't tell you how many people in the last week or two, right? So this really started like, I'm probably going to get this wrong. You know it better than I do. But a few months ago was really when this big climb, but you could go back to like mid last year. It started climbing. Now it just shot up, more recently, but that's of course when everybody starts talking about it. And of course they're asking me like, should I get in? I'm like, man, the time to get in was gone. Like any moment, something will change. It has to. Like it's not going to go up forever. Everybody wants to think it's going to go up forever. And I was like, man, this is not the time. It's probably too late. And I'm definitely not going to advise someone to do that, right? I'm not going to say, hey, this is a great idea. Go buy gold. But you have to, and you also have to know, I think, people that had bought it were like, when do I sell it? And like, when you start getting too scared to sleep at night? How about that?
Yeah. I mean, that literally, I do not understand how people can trade just on fundamentals, or, for most retail investors or TSP people in TSP, it's you talk to your friends and, what are you in? And if you're not looking at a price chart, you're completely guessing. I mean, if you look at weekly charts, we talked about it on the member call yesterday. If you look at weekly charts, I wish I had it handy, but the weekly chart of gold, it is so clear when it broke out, and it's up more than 100% since it broke out like last year. And then if you put just if you're looking at a weekly chart, even if you put a 20-week moving average line, like we talk about on the C fund all the time, if it breaks down through that line, you sell it. Yeah, you're not going to get out at the top, but you're going to make a ridiculous amount of money. But when, anytime things go parabolic like this, there's no telling where the top is, and there's no telling how far down the correction will go. So if you don't have any guide rails, I don't know how you do it.
Yeah, well, you don't. I don't know how. Yeah, I agree with you. I mean, I know professionals that miss the same things, but they also don't try to time it like that. So, but it is. But I was just looking at the and then just kind of, this is kind of free balling it, but if you got in on the right day or whatever, and you got it at the right time, so maybe you made 50% or 30% on gold. Let's say it made it up to that level, and you say, when do I sell? Well, like you just pointed out, let's say your line in the sand was, okay, the moment it gets close to the 20-week or 20-day moving average, I'm looking at the daily.
Sure.
You still would have made 20%. 15%. Like it still would have been a great trade,
Yeah.
but of course you'd be like, I should have got out early. Yeah, of course you should have, but you wouldn't have had a lines there, right? So that wouldn't have happened. That's another thing that I think a lot of people really lose out on is if they didn't get the best version of the trade, they think they lost.
I mean, we're talking about trading, right? It's not TSP,
right. This is not.
It's not. You're not following the trend. So you can either, if you're trading a stock or an ETF or whatever, and you buy it on a breakout, if you look at past breakouts, and if they went, say, 10 or 15%, you say, okay, when it hits 9%, I'm getting out, right? Or basically, you need some kind of historical reference, and then you just you have a target. You could do a 1.618 extension. You could do all kinds of different things to make a target, but when it hits that target, you just get out, and you move on to the next setup, because you're much better off buying a breakout, because that's when the risk is the lowest and the potential upside is the highest. So you hit an upside target, you get out, and you move on to the next thing.
Yeah, absolutely. And just to kind of point out for people that aren't members and are watching this publicly and everything, and don't know much about our models, so we give multiple models to our members, and so they can choose which one feels right to them, based on their personal circumstances and risk tolerance and all those things, right? They kind of go through a course to learn that, and then they choose a model to kind of use as something to go by. And just using one of our, we call it the short-term model, you would have explicitly seen that you had a pretty good trend change in buy trigger, if you want to call it that, back in 2023. And this is on a weekly basis. Back in 2023, right? So a while back. If you just kind of it stayed flat for a good while, probably through to 2025. But if you'd have been watching it through that whole time, you would have clearly seen that it stayed in the sort of buy trigger realm for 2 years, right? And then started. And then just climbed and climbed and climbed. And that was like I want to say it's like 150%, return. So this stuff works, but you do have to be paying attention to it, right? And you can't just ask your buddy at the water cooler. Like, you actually have to do it. We try to tell our members all the time to go through our courses and learn how to do this stuff, right? You learn a little bit of technical analysis. You learn about how to make the allocations based on your situations and all those stuff. And then not only can you apply that to the TSP, but sure, go, open a brokerage account and go buy gold if you want to. Now you better be watching it, and you better be paying attention and doing like the things like Jerry was talking about with having your kind of lines in the sand. And that's very easy to do with just a few tools. And anyway, we kind of got off track here I know we got a lot to talk about for the TSP, so let's just rock and roll.
All right. So February 1st, we're already getting into 2026, and it's going to be quite the year. We'll take a look at some of the economic highlights. There were some important ones this week. There is a lot of talk in the Facebook group about as of January 28th, you could start doing TSP Roth conversions. And I'm going to go through a couple of slides from the TSP.gov site and talk about a few things, and give you guys some ideas to think about just in general about whether or not you want to look at doing a conversion. And then we'll look at the dollar and the 10-year yield. Both of those are having a huge impact on the market right now, and they're going to for a while. We'll do a TSP or a S&P 500, our C fund, a little analysis on that, and then the TSP fund direction. So consumer confidence absolutely collapsed from 92.4 to 84.5 this week, despite the GDP Now estimate of fourth quarter GDP for 2025 is now at 4.2%. So the economy is growing. I mean, 4.2% is a huge number. The economy is growing, but consumer confidence is collapsing. And it just kind of goes to that K-shaped, they always talk about this K-shaped recovery, and the top, 1% is basically sucking all the gains of this market out. And if you are living paycheck to paycheck, life is getting much worse for you. If you're not living paycheck to paycheck and you have assets, those assets are growing. So it's definitely a bifurcated economy, and it's getting worse. The January Fed meeting was this week. The Fed chairman came out on Wednesday. I think it's his second to last. I think he has one more meeting as the Fed chairman. They decided to keep interest rates unchanged, which I'm sure was not looked upon very well by the administration, but they kept interest rates unchanged at the range of 3.5 to 3.75%. Again, that's the Fed funds rate. That's only the rate that banks charge each other for overnight lending. It really affects they call it the short end of the yield curve. It's like, 6-month bonds, 1 year, maybe 2 years. But the interest rates that we really care about are the 10-year, 20-year, 30-year, because those are credit card rates, car loans, mortgages. And we're going to get to a chart on that. And so the new Fed chairman got announced on Friday. It's going to be Kevin Warsh. So if you look him up a little bit, he's got a pretty interesting background. Definitely a Wall Street guy. And then we had PPI that came out on Friday. Producer price inflation, it was way up. And this is the chart of PPI. It's a 3-year chart. And, it's not the highest monthly increase in the last 3 years, right? That was a few months ago. But the problem with the Fed continuing to cut rates, or the new chairman coming into with the expectation of cutting rates, is that inflation comes back in a hurry, and nobody wants to see that. And this is, the first indication. If it keeps going up from here over months, we're going to be back in a situation where, inflation is back at 9% or higher, like it was in 2022. So if you lower rates while inflation is going up, it exacerbates the inflation problem. So it's going to be really interesting to see what the new Fed chairman does if the administration is trying to get him to lower rates, and he's looking at the data going, I can't lower rates because inflation will go way up. So we will see. Okay, TSP Roth conversion. So if you go to tsp.gov, on the homepage, it's in the featured topics. Okay, so you scroll down a little bit, it's on the bottom half of the page. You go to the featured topics, and you got Roth conversion available as of January 28th. So if you hit the read about eligibility and rules, this is the page that comes up. Okay, and there is a ton of information, but in the side column there, and just scrolling down. But it's the first page of it really kind of tells you the whole story. A Roth conversion lets you move money from your traditional pre-tax balance to your Roth or after-tax balance in your TSP account. You can do this anytime during your working years and in retirement, as long as your traditional TSP balance meets eligibility requirements. It's like $500 you have to have, and basically you can't convert less than $500. If you don't already have a TSP balance, your first conversion will create one. I would definitely go through and look at that PDF that they do that talks about it. The main reason to consider a conversion is that it changes when you pay your taxes. It doesn't really change that you will pay them, just when you will pay them. So here's the trade-off, right? You pay taxes now on the amount you convert so that future growth and withdrawals from your Roth balance can be tax-free. So I'm sure everybody understands this. What that means is if you have a Roth account and you're contributing to it every payday, when you retire, you're paying in after-tax dollars. You're contributing in after-tax dollars into a Roth. If you're in a traditional TSP, you are paying into the Roth before you pay taxes. So you're going to pay tax when you withdraw the money. So that's the difference. There's no fee to convert to a Roth, which is great. But the amount you convert is added to your taxable income for the year. Okay, I'm going to get to a slide on that next, but that's how they kind of get you, right? The amount you convert is added to your taxable income for that year. So you have to work with a tax advisor, because what you want to do is make sure the amount that you convert every year doesn't push you up to the next higher tax bracket. So you must pay the income tax on the conversion amount using personal funds from another source, such as a savings account, that sounds a little bit ominous, but it basically means just like you would always pay your taxes, you pay them however you do that. You can't use part of the amount that you're converting to pay those taxes. And how much you owe depends on the size of your conversion and your current tax bracket. So again, we're going to talk about that in a second. And then finally, keep in mind that the Roth in-plan conversion cannot be reversed or changed. So if you do it, you can't come back later and say, oh, I changed my mind about what I think I'm going to do in retirement, and my taxable income is going to be less than I thought. So, I want to go back to a traditional or something like that. You can't do it. So when they say down there, we strongly recommend you talk to a tax advisor. That's probably the most important part of this page, because everybody's circumstances are going to be different, right? That's why I have this as just stuff for us to talk about. Everyone's circumstances and assumptions are different. So when whether the question is up in our Facebook group or you're talking about it, around the office, there is no right and wrong answer. And we're talking about, Roth conversion. We're not really talking about whether or not to start a Roth account when you're really young in your career. We're more talking about Roth conversion kind of later in your career. There's only a couple things that really that we're really talking about. Your current tax bracket. So the converted amount adds to the annual income for for tax purposes for that year. So that's a known, right? You can Google, if you don't already know, what the tax rate is, what tax bracket you're in. And so there's actually a link on the tsp.gov site to that. So you can know that, right? You know your current tax bracket. So if you're at the bottom of a tax bracket, and say if you made another $50,000 that year, it wouldn't push you up into the next higher tax bracket. Then you might say, okay, I'll convert 50,000 this year because it's not going to push me up to the next tax bracket. If 52,000, let's say, pushes you up to the next tax bracket, then you don't want to convert. Say if you wanted to convert 100,000, you might not want to do that. Maybe you'll do 50,000 this year and 50,000 next year. So those are the things you're going to talk to your accountant about. But that's a known. You can figure that out. The anticipated tax bracket in retirement is the big one, right? If you are, depending on how you get your income in retirement, if you're going to go get another W-2 job when you retire, that's going to increase your taxable income. If you're going to live off of TSP withdrawals or other investment, withdrawals from that, those taxes are different. So, and of course, there's no way to know what the actual tax rate is going to be in the future. So if Trump's trying to bring taxes down, right? Do taxes go down? Are they going to be actually lower in the future than they are now? Or are they going to be much higher? Nobody really knows that. It's an unknown. So you're kind of guessing. You have some kind of idea of what you want to do in retirement. If you're going to start a business and you're not going to pay yourself as a W-2 employee, that will have a big impact on whether or not you want to do this Roth conversion. And then the other one that they don't talk about, nobody really talks about it, is that Roth reduces potential TSP contributions, possibly, I'm saying. So because you're contributing to a Roth TSP after taxes, you have less cash flow. So it's possible that if let's say you're maxing out TSP, and once you do your budget, with your current budget, let's say if you have a traditional TSP, you can max out your contributions to TSP because it's pre-tax, right? If you convert to Roth, then you're paying after-tax money. So you're going to have less cash flow every payday by contributing to a Roth. So it just depends on, again, everybody's circumstances are different. If you are a high income earner, or your circumstances are that you can max out TSP even in the Roth, then awesome. But just know that if you're close to that, it's going to be harder to max out. And so if you can't contribute as much as you were before, then your gains are going to be less than they would have been. So that's something that no one really talks about, but it is actually captured a little bit in a TSP Roth conversion calculator that is on the TSP.gov site. That conversion calculator is really good, and if you work through it, you don't have to log in or anything. It doesn't use your actual numbers, but you can go through there and get a pretty good idea of, you put in your current tax bracket, what your expectations are in retirement, how much you have in TSP right now, or how much you want to convert, and it'll walk you through how much your taxable income will increase every year, or the years that you do partial rollovers. So you don't have to do it all at once, right? You can do partial rollovers every year until you roll over the balance that you want. So there's a lot to it, and at the end of the day, you have to talk to a CPA. If you're talking about it with your buddies and everybody says, yeah, the Roth conversion is a no-brainer, it's not true. It's not for everybody. If you're young in your career, it's probably a no-brainer. If you don't have very much to roll over, it's probably a no-brainer. But everybody's circumstances are different. All right, that is all I got on the Roth. Conan, you want to talk about that at all?
I think you definitely hit all the notes there. I think the most important thing, obviously, just to keep pounding on this, you have to talk to some sort of a tax person, right? Because that's how you figure it out. That's the easiest answer when people ask me, should I do a Roth? Should I do a traditional? I'm like, you got to talk to a tax, because I don't know. Like, it depends on when you do it and what your overall goal is. Like for some people, doing a little bit each year, for a lot of people, that kind of works out well, as they convert it chunk by chunk. So it's not this huge tax bill they have to pay. And then by the time they actually retire, now what they have is a pretty big pot of money that's already had all its taxes paid. And if you roll that over into an IRA that now has the gloves off, right? All the taxes have been paid, and it's in an IRA where you have all sorts of opportunities that you didn't have in the TSP. That's a pretty good scenario. Like that's the part that I would have used it for years ago if we had that option. Because now all the taxes are paid, and I've got this big chunk of money. If you're lucky or you've been good at it or whatever, you probably have close to $1 million. You roll it over into an IRA, and then you can get into some really, potentially good investments, right? Because in an IRA, depending on how you set it up, you can invest in a lot of different things. And so the next 20 years or whatever, let's say you retire, in your late 50s or early 60s, you can build a pretty good, a nest egg there, more than you probably could have in the TSP. Anyway, yes. So I think it's a great opportunity that they gave us, but you have to sit down with a tax person and let them help you figure it out. And it's worth the money. Pay somebody. Don't ask your buddy.
Yes, 100%. Okay. So the dollar and the 10-year yield. We've talked about this, periodically over the last couple of years, but I put up this chart a while ago. This is a weekly chart of the dollar. Okay. So the dollar has been in an uptrend since really 2008. Okay. It cycles pretty well. We got a lot of support on this trend line. We just broke in a big way down through that trend line. So it's very likely that we get some kind of correction back up, hit resistance there, and keep on going down. That's the dollar devaluation scenario that you may hear people talking about. There are a lot of countries out there that do not want to hold U.S. debt anymore. And if the demand for dollars falls because countries don't need to hold dollars to do transactions anymore, the biggest one is the euro dollar, where there are a lot of examples in the past couple of years of countries trading oil not using U.S. dollars. And that has been, it's not a treaty, but it's been basically the sort of the gentleman's agreement around the world since the 1950s. And that's all breaking down. And so that's one of the biggest hurdles going forward for the United States in a big way. I don't want to get derailed on that, but it's really, really important, and it shows up in the chart of the dollar. So as the demand for dollars decreases, if the dollar continues to decline, it will have huge impacts on stocks and bonds and all of it. So that's one of the things why we're saying 2026 is going to be such a transition year. That's one of them right there. And the other big one is the 10-year Treasury yield. So 30 years, the 30-year yield is the mortgage rate, basically, plus whatever fee the bank adds on. But so the 30-year one is an important one, but the 10-year yield is really what everybody looks at, that they talk about as the kind of the middle of the long side of the yield curve. So we had the lowest yields ever, right? It's like basically 0.5% back in 2020, right? So that was the time everybody bought houses, and if you bought a house back then, for good or better or for worse, you got a really, really good mortgage rate. And say, like, I think the cheapest was like 2.75%. And if you bought a house back then, now mortgage rates are up here at 6%. You're stuck in your house. You're stuck in that rate, right? No one wants to sell a house because when you sell it, you give up that interest rate. So that's a big part of the problem with housing, because anybody who bought back in here got a rate that you're probably never going to see again. And so those houses aren't selling. And now if you want to buy a house, your interest rates, are way higher. So if you're a new home buyer, it's very, very tough. And it looks like it's going to get worse. So this is a chart of the 10-year yield. Okay, it's weekly. You got a 1, ABC for 2, 3, 4, 5. Okay, so it's an Elliott wave, 5 waves to the top. So 1, 2, 3, 4, 5. We put in a top at 5% back in 2023. And it's not coincidental that this big breakout in yield happened at the beginning of January 2022, which was the top in stocks, right? And then 2022, we had that bear market in stocks. It's also not coincidental that this was the top in 2023, which was the other top. So yields aren't the only thing that matters in the stock market, but they have a big impact. And so we got to this top. So this 5 moves up is a 1. This whole piece is a correction to this move higher. Okay. The correction, ideally we would have gotten, a 1, 2, 3, 4, 5, and rates would have come back down. And that would have been the last best place to buy a house or a car or whatever, because rates would have been, pretty low at that point. But that's not what happened. We're getting what's called a flat consolidation, which is what this is. So we have a 1. We have an ABC for an A, ABC for a B, and then we have a 1, 2, 3, 4, and we probably come down again in yield for a 5 for a C. This ABC is a flat consolidation. And if it plays out that way, the next move is much higher. Okay. So that's the chart pattern. I don't know that that's what's going to happen. I'm saying that is the chart pattern, and it is clear as can be. So we might get one more move down in yields. It should get below this low. It can't get below this low. If it gets below this low, then it's going lower, and that's fine. It's just a different pattern. But what it looks like right now is we get down here somewhere, and when it turns, it skyrockets, and that will not be good for stocks, and will not be good for housing, and will be very rough on the economy. So the dollar and the 10-year yield are, if you're trying to follow what's happening in the economy, those are two big ones. And if you zoom in on the 10-year yield, right? The last chart obviously was kind of a long-term chart. If we zoom in and look at it, we've been in this sideways consolidation since, say, August of, what is this? This is going back to August 2025. So we're at 4.2 on the 10-year yield back here in August 2025. Gap down, right? Stay below that line for a long time. Break back above it here a week or so ago. Come back down and test it. And if it keeps going, like, that's it. I mean, this is a really bad, this is a much shorter term chart, but it certainly looks like the 10-year yield wants to go higher from here. Okay, so this is a current S&P 500 analysis, right? The yield and all that. Yeah, is it going to have an effect eventually? Absolutely. But this is what the S&P 500 RC fund looks like right now. So this was the bottom after COVID. Okay, this is a weekly chart of the S&P 500. And this is just some really basic analysis that you guys can do if you pull up a price chart, all right? All I did was start at the bottom from COVID and connect a line to the bottom in 2022. And then I just extended that line and it hits these 2 points. So it makes a really solid lower trend line, okay? And in TradingView, you hit a tool that's called clone. And so all I did was clone this line and move it up to this top. So now you have a parallel channel, okay? And right here was the peak in October. We just barely poked above that channel, came back down. So we've hit resistance at that line, at that upper trend line. And we've been churning along that upper trend line since October. So if we break above it, that'll be great. If we break above that trend line and we get up here, any pullback, we should get support at that line, right? Just like we were getting support at this lower trend line. But for right now, until we break above there, the expectation is that eventually it breaks down. So it hasn't happened yet, right? So you have to be open-minded to both scenarios. Can it break through this trend line and keep going? Yes, absolutely. Can it not break through that trend line? I mean, this triangle is not great. If it breaks down, the last couple times it did that, right? It broke down, came down to the previous high, right? That's what these horizontal channels are. It's basically showing that over the last 5 or 6 years, every time we had a major pullback, it came back down to the previous major high. Okay, we had a top here, came back down to that April low last year. That was the top in 2022. And we have this rally that we're in right now. If we have that breakdown, it should come down to the high from 2025. This is a 12% decline right here. So that's what you're looking at. And we would expect either support here and it keeps going, or not, or it breaks down and continues down to this trend line. Okay, and then we get support here or not. So those are the points. It gives you a guideline, right? If the market breaks down, right, if we get below, down here somewhere and it keeps going down, you can expect it to come down to this level. If it finds support there and turns back up, great. It's a great time to get in it because it's probably going to keep going at least back up to this trend line again. If it breaks down from there, it's probably coming down to support at this trend line. So we're not trying to guess which way it's going to go. We're just showing the support and resistance levels that are places that give you an opportunity to get in or out of the market at low risk levels. Okay. All right, so TSP fund direction. This is kind of the summary of the S&P that we do every week. This is a weekly chart of the C fund. So each one of these ticks is 1 week of price movement. The blue line is the 20-week moving average line. We got relative strength and MACD are momentum indicators. And so as long as price stays above that 20-week moving average line, right, it tends to find support there. right? Every time it comes down and hits it, it finds support until it doesn't. And when it doesn't, that's when you tend to get significant pullbacks, right? This is the April bottom from last year. And then once we got back above it, we've been, we come down, we got support, right, at that 20-week moving average line. And so where we are right now is we are in the uptrend, right? We've basically, this is the October high I was talking about. We've made almost no progress since that peak in October. The C fund has been pretty much flat, but it's still above that rising 20-week moving average line. So it has not broken down yet, and it may not. It may continue higher. It could break out to the upside. That's a possibility, because this is a consolidation. This is a flat consolidation. It can go either way. So it's a time to pay attention. That's all I'm saying. You have a declining relative strength, right? And MACD has been negative here since November. So the momentum of the rally is weakening. The price is consolidating, and it's going to break one way or the other. So all I'm saying is pay attention, because it's not going to stay flat for very long. And then the F fund, we've been talking about this for a long time. It's, in the long term, it's been at that 100 level going back to the middle of 2022. Most of the time it's hitting resistance as it tries to get above that 100 level, right? We had a little bit of an overshoot here, but it's hitting resistance and rolling over. And since September, it basically hasn't gone anywhere. And for the last 10 weeks, it really hasn't gone anywhere. And all that is, it's a coil. It's tightening, and it's gonna go one way or the other, right? It's probably not going to dribble one way or the other. It's either going to go up or it's going to go down. If the F fund breaks to the upside from here, okay, it means interest rates are falling. So there's two possibilities there. If interest rates are falling and the economy is doing well, that's good for stocks. So then the F fund and the stock funds go higher, right? If the F fund breaks out to the upside, rates are falling. If they're falling because the Fed is cutting rates to try to put a floor on falling stock prices, that's not good. That's when we use the F fund as a tool, because the stock funds are falling and people investors are fleeing to the safety of bonds, and so the F fund goes up and stocks go down. So that's the two possibilities if the F fund moves higher. If the F fund breaks down, that means interest rates are going up. That is definitely not good for stocks. It can be, right? If you looked at a chart that overlaid the S&P 500 and interest rate, or the 10-year yield, coming out of COVID, rates were going up and stocks were really going up, right? Because the Fed was pumping all this money in there, and the stock market was going up. But there are other times when, like now, if rates go up, that is not good for stocks. It puts a lot of pressure on stocks. So which way the F fund breaks out is going to be really important.
Yeah, but let's talk about the other option, right? It's not as probable, but we've been looking at it for almost a year, where it could stay range bound, not quite as flat maybe as it looks right now. I mean, right now it's extremely flat. But if you back up before that and you're looking at from a macro kind of standpoint, you zoom it out, that's generally sideways. Yes, there's some up and downs, right? Kind of like a heartbeat. That would probably be more probable if it does stay range bound. It would be a little more movement. I would really be surprised to see it stay just flat like it is right now. Yeah. But that's another option. I mean, we could go an entire year or more with just, sort of a range bound. It's kind of been stuck in that for, I can't see it's how far back it goes, but at least 2025, right?
Yeah, this is the middle of 2022. I mean, we've been here for years.
That far, that's definitely range. But you this is a weekly.
Yes, weekly.
Yeah, so I mean, you would still see a lot of up and down. I'm more, being a little more recent and looking at kind of after the middle of 24. It's really been in a really tight range there, a channel, if you will. Yeah. Looking at it on a daily basis, probably not. But all I'm saying is, like, there's always a third option. It could just continue to go sideways. that normally doesn't happen for long periods of time. As you can see, as you go back, we do have up and downs, but I just want to throw that out there that could happen. I wouldn't expect it to happen, but it could. I mean, I think the takeaway right now over the last few years is pretty much anything's possible. It's just how volatile it's going to be, right? It's going to go up. It could go up. It could go down. It could go sideways, right? That's the three options.
Yep.
How fast it does that, right? And a time frame is really what we're most concerned about, right? If it does it for these short time frames, it's really difficult to kind of make anything out of that trend, useful, right? What we need are trends up or down that stay there a while.
Yeah.
That makes it way easier to be an investor. It's this fast up and down. It's the sideways stuff that really just drives you crazy. And that's kind of what we've been dealing with for a while.
Yeah. I mean, you're absolutely right. It's much, much easier for TSP investors if the market is moving in a channel in one direction or the other. When it's moving in a channel sideways, you get false breakouts, either to the upside or the downside, and
it makes it the hardest because of the two move rule, right? Because you only got 2 moves a month. 3 or so, if you're moving back to G, you can always move more, in increments backwards to G or all of it to G. So, you can end up with more than 2, but basically you got 2. And that's what really hurts us. And that's probably not going to change anytime soon. So it is what it is. But if you're watching this and you're trying to manage it, that just first of all, watch this show every week because we're going to do all the hard work for you, right? You're going to get the details. You're not going to have to get it from your buddy down the hall. This isn't us just making it up, right? This is data. It's just facts, right? The price is the price. It's one thing I love about technical analysis. There isn't everything's baked into it. If you're a purist at technical analysis, everything is baked into it. Now we do tend to talk about economics because it does matter. But at the end of the day, you can just look at the chart and figure out what's going on.
Yep. Yeah, price is the only thing that matters. There's no doubt about it. I mean, you can talk about, this should happen or that should happen. It really doesn't matter what should or shouldn't happen because there's so many, the narratives are kind of unbelievable. The market went up because Apple earnings went up, or the market went down because Trump tweeted something, or it's
we're so used to hearing that, right, on the news. So it doesn't surprise me. 10 years ago, I was probably that guy too, but not now. And now I know better. And I hope you guys are learning better that, your buddy that tells you, oh, it's because this happened. Okay, maybe, but does that really matter why it happened? It just happened. All right. Well, if you guys like what you see, share it with your friends. Subscribe to our YouTube channel. That helps us out. The biggest thing is if you have any questions or comments, we love to get them. So put them in the comment section wherever you find the video, whether it's on Facebook or YouTube or Instagram. And if you don't see a comment section, you can always email us at support@growmytsp.com. Go check out our website. A lot of good stuff there. If you're not a member, we have a lot of great courses that teach you how to do this stuff. That's our goal, is to educate you, right? We're not trying to be advisors and tell you how to move your money in your TSP. At the end of the day, what we want to do is educate you enough you can do it on your own. And it's not that hard. It really isn't. If we can do it, you can do it.
Absolutely.
All right, guys. Hope you enjoyed the show. Again, share it with your friends if you like it. Make sure you watch us every week. And we hope you guys are staying safe and warm out there, and we'll see you soon.